Lynn, how are you?
I'm good. Thanks for having me back.
Well, it's always a pleasure to have you back. We've got so much to discuss. So much as I can't believe how much stuff has happened since we last spoke. I've the basics I've got written down here: 50k Bitcoin, $1 trillion Bitcoin, Michael Saylor borrowing another billion, Tesla investing in Bitcoin, Stonebridge. I mean, there's so much to get through. It's been just a weird. I mean, just for me, because I only look at Bitcoin, it's been a weird month. I don't think I've ever experienced a month like this. But you look at everything else. Is everything else crazy?
Yeah, probably the craziest thing outside of that is the bond market, the sovereign bond market. Have you been following that?
Nope. You tell me what's going on with the sovereign bond market.
So yields are spiking in a way that is getting somewhat disorderly.
Huh?
And yeah, if you look at, for example, the 10-year Treasury, that was pushing up nearly at 1.5% today. And so if you look back since where it was in August, it was back down at like 0.5%. And over the past few weeks in particular, we've seen a global increase in sovereign bond yields.
What's driving this?
Well, it's kind of rational because for a while now, most of those sovereign bond yields were below the expected inflation rate. Both, the measured inflation rate and the inflation rate that a lot of those markets are pricing in. And so now we're kind of getting this like sharp mean reversion where those yields are pushing up. And so that's going to test central banks around the world to see if they want to try to control the long end of the curve more than they're already doing. Because a lot of them, I mean, most of them have like their major buyers are their central banks, and but they're kind of only willing to buy a certain amount, uh, so they don't look like they're just outright monetizing debt. So now some of the private market participants are kind of reasserting themselves and kind of driving yields up. And so we're going to kind of test a couple things. So for example, Australia, they have yield curve control on one of their I forget what duration it is. It might be their 3 year or something like that, or their 3 month. I forget which duration it is, but they have a specific target on one of their treasuries. And so because it broke above that, they announced a round of purchases to basically try to maintain that peg. And so there's eyes on what's the Fed going to do if their kind of long end keeps pushing up. And it's getting pretty interesting because that pushes down valuations of growth stocks, tech stocks. And so we've seen that kind of sharp reversion where tech stocks are going down. And the reason I bring it up is because that has probably played a role in Bitcoin's correction. Because when you get that sharp uptick in bond moves, you tend to get like a push down in a lot of these kind of duration assets. And Bitcoin has, its overall correlation changes throughout the cycle. Sometimes it's correlated to the S&P 500, sometimes it's anti-correlated to the dollar, sometimes it's a liquidity play. But mainly it's correlated to its own halving cycle, its own adoption cycle. But it can kind of have these shorter term correlations, and so it seems to have been, caught up in some of these bond yields going up and growth stocks going down thing that's happening. It looks like it decoupled a little bit today, but overall that's certainly something I'm watching.
All right, so probably an easy question for you, but like, how are the rates on bond? How are the bond rates set? Does the central bank set them? Is it a market force?
Well, in theory, it's a market force. And so basically the way it works is that the central banks, they mostly set the short end of the curve. They use some of their operations to basically enforce, the overnight lending rate. And then theoretically, all the yields from there, like as you get into 3 month and 2 year and 5 year and 10 year and 30 year, those should all be set by the private market, supply and demand. So the governments sell them, and whatever the market thinks is prudent, they buy them. Now, in recent years, ever since 2008, that's been kind of not the case because some of the biggest buyers of those sovereign bonds are central banks. So central banks create new money and buy the bonds associated with the government issuance. So basically, if you're the biggest buyer, you're obviously impacting price. Now, it's not always the case where they push prices down. So, for example, if we look back in 2008 to 2014, it was an ironic case where whenever the Fed started buying more bonds, yields actually went up. So bond prices, went down. And that's kind of the inverse of what you'd think. But basically, they're providing liquidity to the system. But if they really want to go all out, they can suppress yields. And so, that's why people are talking about yield curve control and things like that, which is, the last time the Fed did that was 1940s, and we're seeing it in a very minor way in Japan and Australia. And we're seeing, for example, spread control in the ECB, where it's kind of informal. They haven't really announced it, but basically they don't want Italian bond yields to get too much higher than German bond yields. Basically for the sake of fairness, and so they're kind of targeting that like maybe 1% differential to avoid a repeat of what they had happen in like this the European sovereign bond crisis back in like 2012. And so it's a really kind of a kind of a turning point for markets because we're going to see how far central banks are willing to go to prevent their yields from rising too much and increasing their government funding costs. And so, for example, if you do yield curve control, like if you go back to the 1940s, the Federal Reserve said, no, we're not going to let yields go above 2.5%. We're going to print money and buy any bonds that try to go above that percent. And so they can do that, but then the release valve is the currency. So they basically lose control of their balance sheet size. The currency, basically is taken out to the woodshed, and you have things like commodities scream higher because you go to deeper and deeper negative real yields. And so even gold in particular would be the legacy asset that does really well in that environment after its recent correction. But Bitcoin also should, if they were to enact that, that should be great for Bitcoin. But I'm kind of watching it in the medium term because as yields go up, that can put pressure on a variety of these things.
What is going on here, though? Is there anything like sinister? Like, what's your most simple explanation for somebody who is an economist who doesn't understand these things like you do? Like, is there something sinister going on here? Like, and I'm going to lay that up with something else, right? And it might be not connected. I've noticed recently, over the last 2 weeks on Twitter, a lot of people are sharing passages from the book When Money Dies. There's a lot of that going on. It's a book I haven't read. I've got it on my Audible. I'm preparing because I'm basically started walking every day for an hour, and I'm going to go out later and I'm going to start listening to it. Is this anything to do with whereby I seem to remember some of the passages people were sharing are things about as a currency is about to collapse, everything starts to get weird.
Well, I think it depends on what you define as sinister. But basically, what we're seeing with this bond move is theoretically rational. So bonds should pay a yield that is above the inflation rate. That's how it's worked for most of history. And so if it's not working like that, that means that bondholders and especially cash holders, because they have low yields too, are just getting killed on a real basis. And so it's natural for especially long duration bond yields to try to push up above the inflation rate. And so that part's not sinister. That's totally normal. The problem is that if you have governments with 100% debt to GDP, or in some cases much higher, they can't afford to pay 2, 3, 4% interest on their debt. They basically would have a fiscal crisis. And so generally, we talked about this before in these long-term debt cycles, they often end with a currency devaluation because any country that's a monetary sovereign, meaning that it issues its own currency, they there's virtually no cases of them defaulting in nominal terms on their government debt. It just because they also issue their currency. So instead, what they do is they'll default in real terms. So they'll have inflation run higher than bond yields for quite a while in something called financial repression, and it's really bad for bondholders and cash holders. And so that's the general path that we seem to be headed towards, where the central banks will basically prevent that from ever kind of reflecting positive real yields. Now, but this is kind of the period where we're seeing that tested because especially on depending on what central bank you look at. I mean, the Federal Reserve as the operator of the global reserve currency, they don't want to come out and say we're monetizing federal deficits. We want to totally override the market. They're kind of using language, kind of keep arm's length, and so the market's kind of calling their bluff and says, okay, we're gonna jack yields up and see what you do. And so, we're gonna get kind of tested, I think. Yeah, later this year. I mean, it's happening a lot quicker than people thought, but basically, as we progress through months and this year, it's kind of going to be an interesting test. It's kind of the opposite of last year because last year we had this big deflationary shock. We had all this money thrown at it, and now we're kind of on the opposite side of that. We're getting the rebound. We're looking in this, hopefully later this year, more and more reopenings and people getting past this virus, and uptick in commodity prices, more of these stimulus effects, kind of increasing money velocity and things like that. And that's where we test, okay, I mean, we can look at the governments and say, how are you feeling about 2 or 3% bond yields on your 120% debt to GDP? And so we'll see what happens.
It's interesting. I was interviewing Balaji the other day, and we were discussing the nation state case for Bitcoin adoption. I'm not sure if you read his article about his case for India to adopt Bitcoin. It's brilliant. If you haven't, I'll send it to you. But as part of the conversation, he talked about the fact that he actually thinks currency wars. We're approaching the stage of currency wars now. Increasingly, countries are probably wanting to. Some countries are perhaps wanting to get off the dollar as its reserve. Certainly, we're going to see pressure from China, but also we've got Bitcoin in the mix now. Is this something you're expecting?
Yes, and I covered that with the article from a while ago called "The Fraying of the U.S. Global Reserve System," and that went into Triffin's dilemma and this whole issue. And it's a topic that I've been covering even before then, but that was kind of my complete thoughts on the matter. And so what we're seeing is a couple things. One is, for the past almost 50 years, we've been in the petrodollar system. And the way that works is that, pretty much anywhere in the world, the only currency you can use to buy oil from oil producing nations is the dollar. And so if France buys oil from Saudi Arabia, they have to pay in dollars, even though neither of them have the dollar as their currency. And that was because of deals that US made with OPEC back in the 70s. And they've been able to enforce that with the trade deals and military kind of protection, things like that. It's basically like a gangster. It's like a global gangster thing. Eh,
That's what Balaji said. It was more about the military protection.
Yeah, pretty much. And so we basically said, okay, Saudi Arabia, you'll basically be under the umbrella of U.S. protection. We'll protect the supply lines, like the shipping lanes and things like that. But you have to just sell your oil in dollars, and then whenever you get those dollar surpluses, go ahead and reinvest them in the treasuries. And that worked for a while because the U.S. was the biggest importer of oil and commodities in general. And we basically, we were a very large force. But over time, as we've seen the rest of the world grow, the United States percent, the global percent of GDP that the United States makes up dropped from something like 35% down to like 20%, which is still big, but it's hard to kind of have that global lock on oil when you're, roughly half the size of the global GDP that it used to be. And now China is the biggest importer of commodities, and so that's kind of posing an issue. And so we've seen, for example, that's where you get into kind of like military stuff where we've had some smaller nations try to price oil in dollars in the past, and it hasn't really worked out for them. They tend to get invaded, or and then they quickly go back to pricing in dollars. But starting a couple years ago, Russia made the move where they said, okay, one, we're going to sell all of our treasuries, so we're going to de-dollarize. And so their central bank invests heavily in gold and euro denominated assets. And then they also said we're going to start selling oil predominantly in euros. And so been increasing their sales to Europe in euros, and also to China in euros, as well as some of their local currencies as well. And going back to India, they've been having like oil and arms deals where they actually managed to sell some of that in rubles. And so we're basically seeing Russia kind of lead that trend. And now, of course, we're seeing China, accelerate their digital currency initiative. They're now the world's largest trading partner with most countries around the world. And so, of course, when you have nations like that can't be attacked, they can't really be physically threatened, do that, that's a much more credible change to the system than we've seen in the past. And so that's where you get trade wars, you get sanctions, you get things like that. But there's really not a ton that can be done about it. And actually, I've argued in my piece that the United States eventually needs to turn away from the system too, because the United States, even though some people in the United States are benefiting from the current system, many people in the United States have actually been harmed by the system, because in some ways we've had another type of currency war for a long time, which is basically that most countries try to devalue their currency so they can keep running export like trade surpluses to the United States, and the United States has had a 50-year trade deficit. And so basically this could revert and kind of balance that kind of structural imbalance out as the global monetary system shifts. But of course, there's going to be interesting changes along the path. It's never going to be a smooth ride.
Has oil ever been settled in gold?
Um, I don't, I'm not sure, but I mean, you can go back to, like, for example, Luke Groman would make the argument that Russia's basically been selling oil for gold for years now, because what they do is as soon as they get the dollars or the euros, they just plow that into gold on their central bank balance sheet. And so, you can have countries that certainly settle in things that are other than dollars or treasuries. But and prior to this current system, we had the Bretton Woods system where the dollar was backed by gold, and that was a different way of settling trade. And so indirectly, yes, you had oil settled in gold back then.
So I guess some people are looking forward and thinking, well, will we ever settle oil in Bitcoin? I guess it's too volatile right now, which is probably one of the reasons why. Am I thinking the reason that Russia settled in the euro is because it's still a stable currency and still a widely accepted currency?
Well, a couple of reasons. One is it's a really big trading partner for Russia. I mean, Russia provides something like 40% of Europe's natural gas. I forget the exact number, but it's a very significant percentage, and so that's a very big trading partner for them. And it's the second largest currency in terms of global reserves around the world. And so basically, they said we don't want to do the dollar, but we'll do euros. And I mean, the tricky thing with Europe is that there's no euro bond, right? So basically, countries never hold their reserves in cash, or at least mostly they don't. Russia actually did, they held some of their reserves in physical cash because they were concerned about sanctions. But for the most part, they hold it in sovereign bonds. They take the surpluses they get and they reinvest in sovereign bonds. So reserves consist of treasuries, they consist of all these different sovereign bonds. But Europe has no central bond issuance. You have to invest in German bonds. You have to invest in France's sovereign bonds. And then they generally don't want to invest particularly in Italy's sovereign bonds. And so that kind of limits to some extent how far Europe can go as a global reserve currency. But especially for Russia, it's been appealing for them, along with gold.
Right, is that because essentially the euro is just it's like a monetary union? Am I correct in this? I heard this before. It's a monetary union, but not fiscal union.
Exactly, yes.
Yeah, yeah. So in terms of, sorry, this is just some stuff I'm learning about. So this, for example, these French bonds. What is it? How do they actually handle their situation? Because if they don't actually manage their own currency, are they in like a slightly different position? Because like in the US, where you've talked about, they can pay back in nominal terms, but they can also drive up inflation, so the purchasing power's lost, but they can still pay it back. What do countries in Europe do? Because they don't actually control the money printer.
This has been a critical issue for Europe because the United States, Japan, UK, they're all monetary sovereign, whereas Europe they're not. And so that's one of the reasons we've seen, if you look at fiscal spending, as a percentage of GDP around the world during this pandemic, Europe has not been able to do as much because they have to agree with each other. Italy can't just say, we're going to do what the United States did and come out with a 15% of GDP fiscal stimulus, and then we're going to do it again next year, and we're going to basically have our central bank buy a lot of it as needed, because Italy's not monetary sovereign, and neither is Germany, neither is France. And so, of course, some of the countries that have lower debts or better fiscal positions, they don't want to accommodate some of the things that some of the Southern European countries need. And it's been a tricky environment because the monetary union in some ways has hurt Italy more because if they had like a weaker currency, their exports would be stronger. And so it's really kind of benefited the export powerhouse of Germany at kind of the expense of some of the Southern European countries. And it's kind of just a flawed union at the current time. It's a pretty tricky thing for them to do because it's one of those things where it's based more on politics than on kind of sound policy.
So because of that, has the euro essentially strengthened against the dollar? Because I'm just trying to look it up now. I'm trying to imagine the euro is probably strengthened against the dollar at this time because they haven't had the money printer go, brrr, as the dollar has.
Over the past year, yes, we've had the dollar weaken versus many currencies, including the euro. And the euro runs very large current account surpluses, and so it kind of has that floor that keeps it pretty strong. But you kind of get that trade-off. And so if they do less fiscal stimulus, you should get a stronger currency. But then also, if due to less fiscal stimulus, if their economy kind of stagnates, that can make people maybe not want to invest too heavily into them, and that can kind of weaken the currency. And so you kind of get that middle of the road currency strength, where it's neither weakening nor is it strengthening too much.
Okay, it's interesting here. So we've kind of got our exit plan for coming out of the COVID crisis from our government. Thankfully, the kids go back to school in 11 days, which I can't wait for. I love my kids, but yeah, homeschooling isn't the most fun. And then, we've got this gradual opening up of the economy. Non-essential shops, so hairdressers, gyms, and stores will be opening up. A few, I think it's April the 10th, I think it is. And then in May, we've got entertainment venues. And then I think by June, they're looking to have most of the economy opened up. And they're even talking about, you won't have to wear masks indoors by June, July. There's a big festival in the UK called the Reading Festival, end of August. We have Reading and Leeds. They said they're going ahead. They said these festivals are happening. So it feels like over the next 6 months, we're going to get back to some level of normality with any hope. And there's this general kind of like, even though we're still in lockdown, Lynn, there's this general glow of happiness around people. I had to pop in and see a friend earlier and just drop something off at her store. And, both of us were like, it feels like the end of the road here. So are you expecting like a bounce back to the economies? I mean, a lot of businesses I know have struggled. A lot have gone under. Some are going to need finance and loans. Some of the ones have gone under are going to be replaced by new businesses. But are you expecting some kind of economic boost?
Yeah, my overall base case is for pretty high nominal GDP in 2021 because you're coming off really weak base effects. So when you do year-over-year comparisons, it can be pretty high. And then also, yeah, you have that surge of kind of there's certain types of demand that are pent-up demand and certain ones that are not. And so, for example, restaurant demand is an example where for the most part, it's not pent up because you can't go back and replace all the meals you missed, right? You can go and you can have a couple extra meals for a few weeks and people get that out of their system. But some of that economic activity was lost forever. Whereas like travel, for example, you might have like people want to say, I want to take two trips instead of one trip this year. You might have, more kind of travel like that. And so overall, I do think that we're likely to see kind of a spike up. And that's when it gets interesting because countries around the world did these massive fiscal stimulus packages. That bonds were in large part bought by the central banks, and so that directly increased the broad money supply. And so when you have that kind of, but it's been offset by a reduction in economic activity, a reduction in velocity of that money. So if you have an uptick in economic activity and velocity with that increased monetary, kind of amount of money in the system, that's when you kind of get like an inflationary spike. And of course, countries did it at different rates. So the UK increased their money supply by something like 10% year over year, whereas over in the States, we boosted our money supply by 25% year over year. We've been like the cowboys of the money printing, and so we'll probably yeah, we'll probably see it at different rates around the world, but it's going to be fun to watch.
So with that, how does that affect? What kind of things, measures are you going to be looking at the economy? What is going to be the impact on the markets? What do you think? I mean, the strange thing is, you still track the S&P and it's still performing very well. Are we expecting that to continue? Or is it going to be this really weird thing that the economy is going to come out of a glut, and then we're going to see like the S&P drop or something?
That's actually quite possible. And so one of the things we're watching now over the past week is we're seeing a rotation. So the overall index is kind of it's sagging a little bit, but under the surface, you're actually seeing really big moves, which is you're seeing some of the unprofitable, extremely highly valued tech stocks that have done extraordinarily well in 2020. I mean, a lot of them were up 100%, 200%, 300% year over year. A lot of those are sagging really hard, whereas you have things like bank stocks or energy stocks surging. And of course, energy is surging because energy prices are going up because we've reduced supply and demand starting to kind of return a little bit, and so they're liking that. And with bank stocks, they benefit from a steeper yield curve. So when the 10-year treasury, the 30-year treasury, when they go up, banks like that because I mean, their business model is based on borrowing at the short end of the curve and lending at the long end of the curve. And because also, higher, 10-year, 30-year bonds, that should, keep up mortgage rates and things like that. And so you're seeing that rotation from basically growth to value, things like banks and energy. And so if you were to get higher and higher yields, that should continue that rotation. And one of the things about the United States market is that our S&P 500 is very kind of tilted towards those growth tech names. And so it tends to be kind of worse for us if we have that rotation. Whereas UK, if you look at the top it's like energy companies and commodity companies and some financials and things like that. It's a little bit more value oriented, and that's generally a rotation we're seeing. And so it's kind of going to be interesting to see. Bitcoin has, kind of it's traded more like these growth stocks, and so it'll really kind of throw people off if it continues its kind of post having bull run, because all these, kind of bears are thinking, okay, now the Bitcoin trade's done, it's going to roll over like the growth stocks. But if it starts trading like a commodity and keeps going up, that's going to throw a lot of them off.
Wow. Okay, so we should get into Bitcoin because it is it's been wild, Lynn. Um, let's start with the $1 trillion market cap, and there's something I want to ask you. So a while back, I spoke to Travis Kling, and he said to me, he said the thing about Bitcoin is there's a lot of people who can't invest in it because the market cap's too small. It's too risky. Once you get over $1 trillion, this actually opens it up to more investors. How much can you tell me about that?
Well, I mean, there's a couple things. One is some of them, for a while, until we're getting these kind of institutional custody solutions, they couldn't invest in it even for regulatory reasons, regardless of size. And so I talked to investment managers that were like, yeah, we looked about self-custodying, but we can't self-custody investments. And so, for example, they were using GBTC, the Grayscale Bitcoin Trust, as their way to do it. But now we have the build out of Fidelity. We have some of these other like NYDIG or Skybridge, some of these other institutions that are coming out with institutional grade products. It's basically the on ramps for institutions to put it in are much easier. And so, yeah, we basically have been in a situation where, liquidity's been an issue. Even if you were going to invest and if you're running $100 billion fund and you want to put a 1% position in, they're worried that that $1 billion purchase is going to move the market. And of course, back when Bitcoin was $100 billion, and then the percentage of that was actually liquid was lower, that would move the market. And now we're seeing that for example, Michael Saylor can do $1 billion purchases, and he probably moves the market a little bit, but you're not really sure. Like, you're kind of watching it, and you're assuming he's probably in there buying, but as long as they do it smart and they spread their purchases out, it's basically a liquid enough market that you can absorb $1 billion purchases now. And so basically that $1 trillion threshold and that liquidity threshold, that really kind of does make it a macro asset. And so it's basically somewhat normalized, I think, now over the past year, for some of these institutions to have a non-zero Bitcoin position. It doesn't sound like they're wacky. They're not going to get like fired for even recommending it.
Well, it could be the opposite now. I was listening to a really interesting interview with Hamish Bailey from Ruffer, and he was talking about their Bitcoin allocation, and he said obviously we went into the market, and a lot of people were surprised that we were investing in Bitcoin, but we did, and we agreed to a 2.5% allocation, but then the price appreciated, so we actually decreased our allocation because we wanted to maintain this. I think it was around 2.5%, which leads me to another question. If more institutions are creating this kind of, let's say, this allocation percentage that forces them to buy or sell depending on the current price, do you think that's going to lead to a little bit more stability in the pricing, or do you still think we're still going to suffer from the volatility?
Well, my base case over time is that as it becomes a bigger and more widely held asset, that its volatility should go down. And we haven't really seen that too much so far with the post-halving cycle drawdowns. But if you look at things like market cap versus realized cap, each cycle has been by that measure less volatile than the one before it. And so my base case is that that would continue, and that if you see more dispersion among including these institutional holdings, that you're likely to get a little bit more stability there. And as an example, I mean, I hold Bitcoin in multiple different ways. So for example, I have the cold storage holding, but I also have portfolios that some of my members and clients kind of look at it and kind of use for their own inspiration. And so for example, in those brokerage accounts, I'll have something like GBTC as my Bitcoin allocation, just because that's the option that's available in that sort of account. And I've done occasional trimmings to basically maintain that below a certain threshold because it's not like there are people that actually follow that and have to kind of maintain the volatility at a certain level. And so there's certainly other portfolio managers like that are doing a similar thing where they might have had a 5% Bitcoin allocation and then it ballooned to like 20% and they have to reduce a little bit. But then on the same token, if you were to get a big sell off, you might get some of them come in and say, okay, we got to boost up our Bitcoin allocation because we're going to rebalance. And so if it becomes that more widely held asset, it benefits from that rebalancing cycle.
Okay, you can explain something to me that nobody's done in a way that I've been able to understand yet. Can you explain the GBTC premium to me?
So GBTC is not an ETF. It's a closed-end fund. And so basically they don't quickly issue more shares as needed in order to maintain their NAV premium above NAV around zero, like an ETF would. And so basically, if you look at a closed-end
I
fund,
think I think even that you need to. I'm thinking about like other people who don't know this. Can we explain what happens with an ETF then? Like, can you
yes,
explain that like in like on five?
sure. So it's probably simpler first to explain closed-end funds that don't do that. And so a closed-end fund, they've been around for decades. And what they'll say is, okay, this manager is going to go ahead and buy like 20 stocks. And they're gonna do initial public offering, and they're gonna take in a billion dollars, and they can use that billion dollars, and they're gonna build a portfolio of stocks. And then basically that portfolio now trades publicly. You can buy it's basically organized as a company, and so you can buy shares in that company, and all that company does is hold these stocks. And what's interesting about that is that that company is not necessarily issuing more shares. They're just, there's a certain number of shares outstanding, and they hold investments in their account. And at the end of the day, you can look at all their investments and calculate what their portfolio is worth. If you just kind of add it up, that's their net asset value or NAV. And then the market can then price that those shares or whatever it wants. And sometimes it might say, okay, even though we've done the calculations and all, if you add up all the investments that that company holds per share, it's $25 a share. But we want to get in on the action so much. We really like that manager, so we're going to pay $28 a share. And so you're basically paying a premium over NAV. On the other hand, most closed-end funds trade at a discount to NAV because it basically makes it so that because that fund charges a fee on the investments, and so if you basically trade at a discount to NAV, you're basically factoring out the fee essentially. And so
Right. I think I know what's going on. So with GBTC, the fact is it's very hard for some of these people to. There's no ETF. It's very hard for people to buy Bitcoin. So the premium exists, but just because these people want exposure.
exactly, they're saying I'm willing to buy Bitcoin at a 10% premium because I don't otherwise I can't have Bitcoin because in my brokerage that's the only option available to me, for example. And you've seen that happens with some popular funds, but yeah, it's been particularly happening with Bitcoin fund. And so then of course you get arbitrage people come in because when Grayscale issues new shares to basically buy more Bitcoin, the people that the accredited investors like higher net worth or institutional investors that buy into that kind of launch, they get to buy in at NAV. They don't have to pay the premium. But then they have a lockup period where they can't sell the shares for 6 months, and then 6 months later they can sell them at whatever the market price is, which is normally a premium. And so there's been an arbitrage opportunity where someone can buy into a Grayscale like share issuance, and then on the side they can also short Bitcoin. And so basically what they're doing is they're over that 6 months. At the end of that trade, they want to take that trade off, and they'll capture that premium spread with Grayscale. And so that seems to be going away now because we've had a number of other, there's more competition basically. We now have a Canadian ETF.
Hmm.
We have
We have Michael Saylor's shares,
exactly people
MicroStrategy
have been,
shares.
and that's why MicroStrategy was trading at a premium for a long and still is because there are I made this argument before. If you're running a mutual fund, you can only invest in stocks, but you happen to be privately a Bitcoiner. You're bullish on Bitcoin, but your job is to run this fund that can only buy stocks. What do? You allocate to MicroStrategy because that's one of your ways that you can express bullishness on Bitcoin within that portfolio. And so MicroStrategy also basically would trade it at essentially a premium to what it logically should.
Yeah. But as as more of those become available, I guess we have Tesla now. We have Square. We have this Canadian ETF, as you say. I think there's even a Swedish one. I'm not sure on that. I guess that is the competition then. But I've also seen the note that like, the GBTC premium did it go negative for a moment
Very briefly,
recently?
yes. Yeah, it briefly
Yeah.
did. When we had that big sell-off, it went negative, and so for the past couple months, it's been decreasing. And that's just I think because of competition. But then when you have that decreased premium and then you get a sharp sell-off, yeah, it went briefly into negative territory, which is interesting.
Is it risky? Are there any risks associated with that?
I would say not many. The biggest risk would be, I mean, the not your coins problem. So you have counterparty risk. I mean, I think they use Coinbase as their custodian. So you're hoping that there's not going to be an utterly massive hack or fraud or something like that, and you're basically trusting this, the security of that custodian. Other than that, there's not really risk. But I mean, that's kind of a tail risk that, because that they have something like $20 billion of Bitcoin that if they were to screw up that custody, I mean that'd be a headline.
I mean, it'd be good for the rest of us though.
Yeah, pretty much.
Push up the value of our Bitcoin. So, do you think there's an ETF coming? Do you think this is also like a signal an ETF has come in? Because yeah, the SEC is pretty good. I know they I know Hester Peirce is. I think she's pretty keen on an ETF. Jay Clayton wasn't so keen. But the fact there is now an ETF in Canada that does create does put the US slightly behind. Do you think that's gonna? Do you think that's like pushing, giving the SEC an incentive to reconsider this?
I think so. I think the bigger Bitcoin gets and the more that other ETFs exist, the harder it is for them to justify no ETF. And I mean, they can't really use the volatility argument because I mean there are some crazy ETFs out there. There are like triple leveraged or triple bearish ETFs. Like there are absolutely crazy products out there. And so a Bitcoin ETF would by no means be the most volatile ETF on the market. And so basically, it's just an ETF that it gives people exposure to a trillion-dollar asset, a macro asset. And so it's really hard to kind of justify not having one the bigger it gets. I think Kathy Woods of ARK argued that $2 trillion is a threshold, but I mean, those are all estimates. I mean, maybe, $1 trillion definitely puts it on the radar. And then as you get Canada, with their ETF, it basically looks increasingly silly if the US isn't allowing one.
Does the Gemini Trust then become an ETF? Does it convert into an ETF? Or does it just carry
Well,
on as it is?
oh, you mean the GBTC, the Grayscale Bitcoin
Yeah.
Trust?
Sorry. Yeah.
They
Sorry. Not Gemini.
they
Grayscale.
might, yeah, they might. I don't know the full history. I think in the past they were one of the ones that filed to become an ETF, and it didn't really work out. Now, I mean, I know. I was speaking of Gemini. I think they a while ago filed for an ETF. You have VanEck Vectors. They're a popular ETF provider. They filed for an ETF. So it would make sense for some of these, either to launch an ETF or to convert to an ETF. Now, yeah, basically GBTC without the premium, they do have an incentive to basically convert to an ETF, and it's also going to put increasing fee pressure on them because Grayscale I think charges something like 2%, whereas if you look at Skybridge, the Mooch, the Scaramucci's fund, they charge lower, and so over time you should get more and more competition to basically push down these fees.
Yeah. Funny you say that because while we were talking, the mooch just texts me. What does he want? He's telling me there's some huge news. Stonebridge filed with the SEC to become the first open-ended mutual fund to buy Bitcoin.
Oh, there you go. I mean,
There you
basically,
go.
the bigger this asset is, the more that these normal products should be, exist.
Right, so let me ask you about this. So Stonebridge Wright filed with the SEC to become a first open-ended mutual fund. What does that mean? What's an open-ended mutual fund?
So those are actually, in some ways, it's kind of old. I mean, that's what, if you were looking at, say, what Vanguard was doing for a long time, you'd have these open-ended mutual funds. When you think of a classic mutual fund, like you can put money into this kind of, actively managed, or in Vanguard's case, passively managed fund. Before you had the emergence of ETFs in the 90s, that was the classic fund. And so you had mutual funds and you had hedge funds for credit investors. And so over time, because ETFs are, I mean, one is they're publicly traded, and two, they're more tax efficient. And so we've seen kind of a shift from mutual funds to ETFs, although mutual funds are still a much bigger market. It's just that it's like a giant melting ice cube that's kind of moving more towards ETFs. There's actually even funny cases where there are mutual funds that under the surface just hold an ETF because it's more tax efficient. It's funny how that works, but basically, That's another kind of traditional vehicle that 401ks and all these kind of big investment pools of money can invest into. So yeah, if they can get an open-ended mutual fund, that's I mean that's powerful. That means that that's more brokerage access for people that don't want to hold Bitcoin, that still want to have allocations to Bitcoin, but don't want to have like a Trezor or something.
Does the ETF have to hold Bitcoin, physically hold it?
Not necessarily. I mean, there are ETFs for commodities, then all they hold is like futures. So I mean, they need to have an allocation in some way. How they go about that allocation will depend on how they file, like what their prospectus says, and then what regulators allow.
It's got here. I've got the SEC filing. It says seeks to generate returns by gaining exposure to the price of Bitcoin by selling put options on Bitcoin futures contracts. This strategy may also invest in pooled investment vehicles, such as registered or private funds that themselves invest in Bitcoin. But they're here now. Stonebridge are part of the game.
Yeah, no, I'm not surprised.
Okay, the next thing I want to ask you about is how the hell can Michael Saylor borrow $1.05 billion at 0% interest? And how can I do the same?
Well, one of
Because
the
I would
reasons
like
I would like
to
to as
borrow $1 billion.
well. One of the reasons I mean, the main reason he's able to is actually kind of the same problem where let's say you're running a bond fund and you want to
Mm-hmm.
you want to have Bitcoin. You happen to be bullish on Bitcoin, but you're running a bond fund, right? So one thing you can do, so Michael Saylor, what he did was basically those are convertible notes. So if MicroStrategy stock price moons because it's holding Bitcoin and Bitcoin goes up to six figures or whatever the case may be, those bonds in several years' times can be converted to MicroStrategy stock. And so they can participate in some of the upside above a certain threshold. And so that's basically a way of saying that for those bonds, they have virtually no downside risk other than if MicroStrategy defaults, right? So if MicroStrategy, if say if Bitcoin just like some tail risk happens and Bitcoin goes to zero and MicroStrategy's and their cash, I mean, they still have cash flow, so even then they should be able to pay those bonds. But let's say for some reason they can't repay the bonds. That's basically the tail risk those bondholders have. But on the other hand, if Bitcoin goes up a ton, they participate in some of that exposure, and so it's a slightly for them it's a slightly more conservative way to invest in Bitcoin where they don't get all the upside, but they also have some volatility downside protection, except for like the tail risk. And so for them, if you're running a bond fund and you happen to be bullish on Bitcoin, but the only thing you can invest in is bonds, you say, well, I'll take some of these convertible MicroStrategy notes and I'll just have that as like 2% of my portfolio sitting over there. And if Bitcoin moons, then I'll outperform all other bond funds. And if it doesn't, then it doesn't matter. It's a small percentage.
Yeah, Preston Pish tweeted about this. He said, this is what you can do when your balance sheet is doubling every few months.
Yeah, pretty much. And I mean, he went into this with virtually no debt and tons of cash. And so the first steps were to turn the cash into Bitcoin and then to issue debt against it. And so, I mean, because he's hardcore bullish on it, he's willing to take that risk. And so far he's not had regulators seemingly had an issue with it. He's not really kind of run into issue. And so it's worked out great for him because he's been able to buy Bitcoin in some ways dollar cost averaging into it in chunks. He's putting cash flow into it and also doing these occasional bond issuances.
He's $1 million cost averaging it. What a baller. Okay, another thing I want to talk to you about is obviously Tesla. I did not, I did not really see it coming. Obviously, we've memed Elon Musk continually, and everyone's harassed him, and he's finally done it. I was still surprised, and I was still surprised how much. I mean, you look at someone like Square, run by Jack Dorsey, that's invested 50 million, and now another 170. Tesla just comes straight in with $1.5 billion. What did you make of this?
So it's interesting because it's kind of the middle of the road play because it's not all in like Michael Saylor, but it was something like 10% of their cash. And it's funny because I mean Tesla, the reason that some investors weren't really expecting it is because Tesla doesn't really produce free cash flow. I mean they don't really make money from selling cars. They make money from selling equity. So they
Well, they
kind of
make
like
money from Bitcoin now.
yeah, exactly. I mean they've actually made more money from Bitcoin than their
Yeah.
entire history of selling cars ever because until this past year they never really made an accounting profit and then they finally made an accounting profit, but it's very small and it's really only based on like tax credits and stuff. And so they really kind of like cars are like a loss leader for them. And then what they really do is issue new shares because there's always investors willing, happy to buy in. And then so that's how they got all their cash. And then they put some of that cash in a Bitcoin. And so it's kind of funny to see. Whereas Square, they now have something like 5% of their cash in a Bitcoin. And that, I mean, Square in some ways has been like the expected model. And so when people were talking about corporations putting Bitcoin on the balance sheet, most people envisioned it as a small percentage of their balance sheet, and they would expect it. I mean, Square was like a natural kind of first mover, but it was funny because we had MicroStrategy come out of nowhere as the actual first mover, and they went all in. But now that we're seeing things like Square and Tesla put a smaller percentage of their cash into Bitcoin, that's the model you can perhaps see more regularly because few companies are going to go all in, but many companies might say, okay, we have cash yielding near zero with inflation expectations rising. Why would I not have a small Bitcoin hedge in case, my cash gets, impaired by inflation? They can hold things like Bitcoin and say, okay, if Bitcoin goes to zero, our 5% Bitcoin position doesn't matter. But if Bitcoin goes up 10x, it's basically hedged the rest of our cash position.
Well, Tesla has other risks. Like you say, I mean, it's not highly profitable. But also, I was reading this morning that I think it's over the last year they've done something like 13 discounts on prices, reflecting they've got a potential demand issue. And not unsurprising as we're in a pandemic. And potentially they've even got a supply issue because I've been trying to buy my dad a car recently, and you just can't get a car till August. So I wonder if any of that's part to do with it as well. I mean,
He's kind of a natural marketer. And so, I mean, I personally think that Tesla stock is very overvalued compared to what it's worth, even taking into account future growth and some of their growth avenues. I think the current price is very high. And so I personally would not invest in Tesla, even though, for example, once MicroStrategy bought Bitcoin, I actually did invest in that in one of my portfolios because I had the same problem is that in that account, I had no other way to hold Bitcoin, and I wanted to have that performance in that portfolio. And so one of the ways I did was I allocated to MicroStrategy. Whereas, I wouldn't do it for Tesla because one, Bitcoin is, their market cap is several $100 billion, and Bitcoin they bought 1.5 billion of it, so it's a very small percentage of their market cap. And two, I don't like the fundamentals of Tesla compared to the valuation. Whereas MicroStrategy, even though I kind of didn't like the valuation, I was like, nah, this is enough that I can put a small position in and let it moon, and it did.
yeah. But you're not going to short Tesla, are you?
Not now. I've been like, occasionally I would short it if as like a hedge, but then take that short off if it went above a certain price point. And so, it's not this is not a super attractive market for shorting, but I do think that a lot of these really highly valued tech stocks that are unprofitable, like the kind of the ARK funds and Tesla and some of these others, I do think that they could have a pretty significant price correction over the next couple of years.
I think the interesting thing to think about something like Tesla is how I think of my little business as a microcosm. But I told you before that I've been holding Bitcoin on the balance sheet. And my capital position now is quite interesting in that, like, if I want to grow, but we're a team of seven now. If I want to grow beyond that, if I really wanted to ramp up, I'd have a choice of always bootstrapping, taking on investment and losing equity, but or I can actually use now the Bitcoin that I've got on the balance sheet. My problem with that is I don't want to sell the Bitcoin ever. Um, and I did this interview recently with Jamie Litherton, the new CEO of Hut 8, where she was talking about they use their Bitcoin, they borrow money against their Bitcoin because they don't want to sell the Bitcoin. It's more of a pristine asset. I'd be interested in a company like Tesla in the future if they need more money, whether they would consider selling their Bitcoin or just borrow against it. It would be really interesting to see.
Oh yeah, it makes sense, and you should get pretty low rates for that sort of borrowing, and so that I think that's a attractive model because that's kind of the role of Bitcoin as pristine collateral. And for Tesla, I mean, at their current time, because Bitcoin's a very small percentage of what they hold, I don't think they would borrow against that. But in the future, if you were to have Bitcoin to have like an extra zero on its price or something, then that would be a much bigger percentage of their assets, and so they could use that certainly as a source of borrowing if they wanted to. Especially, I mean, the funny thing is, I mean, I haven't checked their credit rating recently, but I mean, I think they're still junk rated, Tesla, because, I mean, let me check it now because until this year, they were actually a junk rated company because if you looked at the numbers, they just weren't producing income and they had debt and people were concerned about a lot of it. But because ironically the stock price did so well and they were able to issue so much equity, they got a ton of cash on their balance sheet. And so it's been a funny thing where Elon Musk has basically memed Tesla into solvency because the massive increase in the stock price allowed him to issue equity and get a ton of cash. And so now it's actually he's ironically improved the fundamentals of Tesla by being a really good marketer. And so if I look
I
up
think
the if I
it's the
go ahead.
strategy that Jim Cramer put out yesterday for GameStop. He said they should issue a bunch of stock and then spend the income on Bitcoin.
Yeah, I saw that. And follow up, yeah, Tesla's on the high end of junk rated. Right? So
Wow.
it's funny because that's just how this year's worked. This it's that that's 2020 in a nutshell in 2021.
Well, 2021 has been a lot better than 2020 so far.
Yeah,
Yeah. Okay, a couple of things to finish out on. I did want to talk to you about the borrow and lending market, the likes of BlockFi, etc. But I think I'm going to save that till next month because I'm going to do an interview with Zach Prince and cover that. So I think I'm going to save that for next month. A
sure.
couple of things I did want to talk to you about. Going back to your report, which, by the way, I say to everyone every month, it's brilliant. I love it. I've subscribed. Subscribe. It's in the show notes. Link crushes it. It's only what did I pay? Like $199 for the year.
Yeah.
It's so cheap, Lyn. It's too cheap. Go and subscribe. It's in the show notes. But I've actually written something down here with regards to the price of Bitcoin. You're saying the higher it gets, the less asymmetric it gets. The opportunities in this cycle, and we may be in for some kind of like high volatility or lengthy consolidation. Can you talk me through that?
Yeah, so I mean, I started covering Bitcoin back in 2017, like I've talked about before, back in November of 2017. And so back then, I expressed concerns about the price. I was also concerned about the Bitcoin fork and things like that. And so I sat on the sidelines, and I wasn't one of those like Bitcoin bears, but I also wasn't bullish on it. And so as we had kind of improving fundamentals in 2018, 2019, like the forks were sorted out, we had the improving network effect, we had institutional grade custodians in April 2020 is when I got quite bullish on Bitcoin. And then I, increased bullishness up to, about June and then just been super bullish since then. And so my point was that as we kind of go along this halving bull market, uh, you know, people start to buy in at these higher price points. And especially, a lot of retail investors tend to get caught up in emotions and they're more likely to kind of go in at the top. And so there's kind of smart money that buys in early or like leverages early, like MicroStrategy, did and what you did. But then there's always like these concerns where if you look back in 2017, there were investors that like bought Bitcoin with leverage at the top. And then there's like stories of them getting like crushed when Bitcoin falls, like, however much it falls. And so my point was that, as we go on this bull market, just be, kind of cautious with the amount of risk you take on because Bitcoin back when I went long at like 6,900 was like a no-brainer. I was like, this thing could go up 10x or more, and so it's like the case for
It's already
having a
nearly done that.
exactly, yeah, pretty much.
We've done
It's
8. We did an
yeah,
8x up to 58.
exactly. We've done 8. And so that was such an asymmetric move. But then as you get kind of deeper into this halving cycle and you kind of, the on-chain indicators start to get more heated, it's a little bit more consensus. That's when it's like, okay, now coming in with your massive, all-in purchase or leverage purchase, it's like just, think this through. Like make sure you know what risk you're taking on, make sure you're willing to handle the volatility. Because last thing I want is someone, coming in towards the later stages of a bull market and then getting hurt. And it's not even that I necessarily think that this is later stages. I think by most indicators it looks kind of mid-cycle, mid-cycle bull run. But basically now it's like I still think it's going higher, but it's less of a slam dunk than it was at like below 10. And
Yeah,
so
Willie said to me the other day, he said it's middle of the cycle. I don't know if you get his email too, but he's like saying retail has arrived. He was seeing like 20,000 new accounts a day or something. So that indicates retail's arrived, which is a signal for middle of the bull market. Although it feels weird to say middle because a lot of the people say the bull market will close out around November. So it's kind of like, well, what's going to go on between then? I've seen such a range of things, Lynn. I've seen you saying it could get choppy at around 100,000. I've seen other people talking about it going through 2, 3, 400,000. Other people talking about it going much higher.
Well, I think that's all fair because it's only been 3 cycles. This is like the fourth cycle, and so that's why I've been avoiding specific price targets. And if anything, I give conservative price targets, and so then it meets them, and it keeps it. Instead of kind of going for the high end target and then maybe or maybe not hitting it, I like to let put low hurdles and then step over them. That's kind of the Buffett quote. Like he likes to invest by like setting low hurdles and then stepping over them. And so uh, that's kind of how I've approached it. And there are certainly like if you look at previous halving cycles, the peak compared to the prior peak, I mean the last time was a 20-fold increase over the prior peak. And so if you were to get that, I mean that's how you get to 400,000. Even a tenfold level over the previous one would be at 200,000. But that's where I think you have to be careful about extrapolating too much because the past is just kind of a signpost. It gives you kind of indicators, and so it can overshoot or it can undershoot either of those metrics by a pretty wide margin based on what happens in macro land. So, for example, if we get that yield curve control and if we get a greater institutional adoption, that's where you can get one of those like say super cycles like some of the analysts are talking about. That's certainly on the table. On the other hand, if you get let's say you get yields rise super far, that could put a dent in the bull run, and maybe the bull run tops out a little bit lower than people expect. There's a pretty big range of outcomes, and it's mainly because supply is known and demand is not. And so the best we can do is kind of monitor these indicators and say, okay, like where are the risks, where are the opportunities, how far are we in? And I think by most indicators, mid cycle is a good way to describe it.
Yeah, I've also noticed with your own work, there's an increasing amount of Bitcoin. It's like the gravity, there's like a Bitcoin gravity into your own work. Have you noticed that yourself? Do you feel you're like looking at it a lot more and writing about it a lot more?
I think so because it's certainly been an area of interest that I want to address, and it's also like if you start from zero, you have to kind of build up a knowledge base and build up a research base on it. And so, for example, I have a long history with precious metals and writing about those, and so I basically have to build up a foundation of reading for people that want to come in and kind of learn about this asset. And it's also a case of where the money is. And so, for example, I was riding the precious metal bull market from 2018 to 2020, and in my August 2020 newsletter, I wrote like, I could see gold being choppy for a little while, and I'm more bullish on Bitcoin. And so it's natural that I've been, emphasizing more on Bitcoin because that's the cycle that's been doing well over the past several months, and it's kind of the place that's been a source of alpha, and so I think it's kind of it goes in cycles. Like if you were to have a Bitcoin bear market at some point, I probably would write about it somewhat less, even though I would still like if there's a topic I wanted to discuss, I would. Like I was writing about gold back in a bear market and things like that.
Well, when your report, when I get my email in that your latest report's out, I almost scroll down to the bottom for the Bitcoin bit first,
Yeah, I know that
naturally.
there's certainly people that like those segments. Yeah.
Yeah. All right. Brilliant. Well, listen, always a pleasure to talk to you. I always learn so much with you, Lynn. It's amazing. Anything else you're looking at? Anything else you want to talk about before we go?
I think those are the main things. I guess the single key thing I'm watching from a macro perspective is what happens with some of these inflation numbers in the next several months as we kind of gradually reopen, and as some of these, and then see how the bond market behaves, and then see how central banks respond to their bond markets misbehaving. And because that can really set the tone and kind of set the math, I guess more specifically, of what happens. And so higher bond yields put pressure on tech stocks, potentially put pressure on gold, maybe Bitcoin, we'll see. Whereas something like yield curve control is like rocket fuel for all of these inflationary assets. If they try to suppress yields while inflation moves up this summer, that's rocket fuel for all these kind of scarce assets.
Amazing. Okay. Tell people where to sign up to your newsletter, please.
So I'm at lynalden.com. Most of my content's free. I also have a low-cost service. People can check that out. I'm also on Twitter at Lyn Alden Contact.
Definitely check it out. I'll put it in the show notes. Go and sign up. It's well worth the $199 a year. Each report is like a book, so I highly recommend it. Lyn, I'll see you in a month. You take care. As I said, I always love talking to you.
Yep, you too. Bye.